Welcome to our channel. If you're new here, don't forget to hit the subscribe button for more informative videos like this one. Now, have you ever wondered how to start investing? It's a question that might have crossed your mind as you ponder about the future. We often hear the word investing thrown around, usually in conversations about wealth and financial growth. But what does it really mean? And more importantly, is it just for the rich and affluent? The truth is, investing is not an exclusive club for the wealthy. It's a tool, a vehicle that everyone can use to achieve their financial goals. Whether you're saving for a new home, your children's education, or your retirement, investing can help you get there faster. It's about making your money work for you, not the other way around. Investing is about understanding the value of time, the power of compounding, and the importance of patience. It's a journey, not a sprint. Understanding the basics of investing can help you take the first step towards financial freedom, and that journey begins here. So, what exactly is investing? Well, imagine it as sowing seeds today with the expectation of reaping a bountiful harvest tomorrow. In financial terms, investing is the act of committing money or capital to an endeavor, be it a business, a stock, a bond, or real estate, with the expectation of obtaining an additional income or profit. It's about letting your money work for you. Instead of laboring for every dollar, you let your dollars labor for you. They go out, multiply, and return with their offspring. Sounds magical, right? But it's not just a matter of snapping fingers and watching money multiply. It's a game of patience, strategy, and understanding. Investing is inherently tied to the concept of risk and reward. There's no guarantee of success, but with greater risk, often comes the potential for greater reward. It's like climbing a mountain. The higher you go, the more breathtaking the view. But the climb itself can be treacherous. The key to investing is managing these risks. It's about making informed decisions and not just throwing your money into the wind. It involves understanding the venture you're investing in, knowing the market conditions, and being aware of how much loss you can bear. And remember, investing isn't a get-rich-quick scheme. It's a long-term commitment, a marathon, not a sprint. Investing is a powerful way to grow your wealth, but it requires understanding and managing risks. Now, you may ask, what can I invest in? Well, the world of investing is like a supermarket, offering a variety of investment types, each with its own potential advantages and disadvantages. Let's start with stocks. When you buy a company's stock, you're buying a piece of that company, becoming a shareholder. Stocks can be a great way to grow your wealth as they have the potential for high returns. However, they also come with a higher risk. The value of stocks can fluctuate rapidly, and you could lose your entire investment if the company doesn't perform well. Next, we have bonds. Bonds are like IOUs. When you buy a bond, you're essentially lending money to a corporation or government. In return, they agree to pay you interest at fixed intervals and return the principal amount at the end of the bond's term. Bonds are generally less risky than stocks, but they also provide lower returns. Mutual funds are another option. These are investment vehicles that pool money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other assets. Mutual funds offer diversification and professional management, but they also come with fees and may not always outperform the market. Real estate is a tangible asset that can provide a steady income stream through rental properties and potential appreciation in property value. However, it requires a significant upfront investment and ongoing management. There are also options like commodities, such as gold or oil, which can act as a hedge against inflation, but are subject to market volatility. Or you could consider investing in a startup through venture capital, which carries high risk, but also high reward potential. And let's not forget about retirement accounts like a 401k or an IRA, which offer tax advantages for long-term investing. Each of these investment types has its unique characteristics, and each may play a different role in your overall investment strategy. Choosing the right type of investment depends on your financial goals, risk tolerance, and time horizon. So take some time to understand each type and consider which ones might be a good fit for you. Ready to get started with investing? Here's how. Firstly, you need to set your financial goals. What are you investing for? Are you looking to grow your wealth over the long term, or are you saving for a specific short-term goal like a house or a vacation? Be clear about what you want to achieve. This will guide your investment strategy and help you determine how much risk you're willing to take on. Understanding your risk tolerance is the next big step. Investing always comes with a certain level of risk. The key is to balance the potential for gains with your comfort level for potential losses. If the thought of losing money keeps you up at night, you might lean towards conservative investments like bonds or blue-chip stocks. If you're comfortable taking on more risk for the potential of higher returns, you might consider more aggressive investments like growth stocks or even cryptocurrencies. Keep in mind, higher potential returns typically come with a higher risk of loss. Research is your best friend when it comes to investing. It's crucial to understand the different types of investments available to you. Are you interested in stocks, bonds, mutual funds, real estate, commodities, or something else entirely? Each type of investment comes with its own set of pros and cons, risks and rewards. Spend the time to learn about each one and how they might fit into your overall investment strategy. Creating an investment plan is where all this preparatory work comes together. This is your roadmap for how you'll reach your financial goals. It should outline what types of investments you'll make, how much you'll invest, and when you'll make those investments. It should also include a plan for how you'll handle potential losses. This might mean setting aside a certain amount of your investment portfolio for more conservative investments, or it might mean diversifying your investments across a variety of different assets to spread out your risk. Lastly, remember that investing is a long-term game. It's not about getting rich quick. It's about steadily building your wealth over time. Be patient, stay the course, and keep your emotions in check. Market fluctuations are a normal part of investing. Don't let short-term ups and downs derail your long-term investment plan. Remember, the key to successful investing is planning and patience. While investing can be rewarding, it's important to avoid common pitfalls. The crucial part of the investment journey is understanding the traps that can potentially derail your financial goals. Let's dive into some of these common investment mistakes. Firstly, there's the issue of not diversifying. Imagine putting all your eggs in one basket and unfortunately dropping that basket. The result? All your eggs break. That's the risk you take when you put all your investment into one asset. Diversification is a strategy to spread your investments across different assets to mitigate risk. If one investment performs poorly, others might perform well, balancing your portfolio. The second common mistake is trying to time the market. It's the investment equivalent of trying to catch a falling knife. The market is unpredictable, and attempting to buy low and sell high consistently is nearly impossible. Instead of timing the market, a better approach is to consistently invest a fixed amount over time, a strategy known as dollar cost averaging. Then, we have the emotional roller coaster. Letting emotions control investment decisions can lead to impulsive actions based on fear or greed. Remember, the stock market is not a casino. It's important to keep a cool head and make rational decisions based on research and analysis, not on the latest headlines or market rumors. Lastly, there's the mistake of not regularly reviewing the investment portfolio. Think of your portfolio as a garden. It needs regular attention to ensure that it's growing healthily and in line with your financial goals. This doesn't mean you should be checking your portfolio every hour of every day, but a regular review, such as quarterly or semi-annually, is a good practice. In conclusion, these common mistakes, not diversifying, trying to time the market, letting emotions control decisions, and not regularly reviewing the investment portfolio can hinder your investment success. But awareness is the first step towards prevention. Avoiding these common mistakes can help you on your path to successful investing. Let's quickly recap what we've learned today. Investing at its core is about making your money work for you. It's about placing your capital in various types of investments like stocks, bonds, or real estate with the expectation of generating a profit or income. Starting your investment journey requires careful planning. First, you need to set clear financial goals. Then you should make a budget and save for investments. Next, you should choose the right investment based on your risk tolerance and time horizon. Finally, consider diversifying your portfolio to mitigate risks. While investing can be rewarding, it's not without pitfalls. Common mistakes to avoid include not researching thoroughly, trying to time the market, and letting emotions drive your decisions. With these basics, you're now ready to start your journey into the world of investing. Remember, every investor started somewhere, and today you've taken your first step.